Welcome to Fun with Annuities, where every single week I welcome a celebrity guest expert that can help you maximize Chapter 2 of your life. Listen, learn, laugh, and love every minute of the most unique financial podcast on the planet. Let's get to it. Welcome to Fun with Annuities. I'm your host, Stan, the Annuity Man, America's annuity agent licensed in all 50 states. I want to welcome everyone on all the major podcast platforms and also on the Fun with Annuities YouTube channel, where you can see me and the guest interact and facial expressions, and you can check out how just utterly fantastically good looking we both are, which is great. Laugh, right? But today's guest is I'm so happy he's here, just because for the consumers that are listening to this, this person is the real deal. He's the true retirement expert. His name is Wade Pfau. P-F-A-U is the spelling of his last name. He's the Miles Davis and the Jimi Hendrix of retirement research and expertise. Obviously, I'm a music guy, but that's who I equate him to. He's in rarefied air. If there was a mythical annuity Mount Rushmore, his face would be on it. He is a professor of retirement income at the American College of Financial Services in King of Prussia, Pennsylvania. He also hosts the Retirement Researcher website, and I would encourage you to go there, retirementresearcher.com. We're going to have all of his links on the site so you can access those, etc. He's a principal and director for McLean Asset Management. He holds a doctorate of economics from Princeton University. He's written so much stuff, you can't even start to count it. Hundreds of articles, hundreds of white papers and research work. He has 4 books that I own, all 4. The first one that he put out was called Safety First Retirement Planning, which is an integrated approach for worry-free retirement. Then he did one that was fascinating called Reverse Mortgages, How to Use Reverse Mortgages to Secure Your Retirement. Third book was How Much Can I Spend in Retirement, a guide to investment-based retirement income strategies. And the fourth one that I just got, Retirement Planning Guidebook, Navigating the Important Decisions for Your Retirement Success. Once again, we'll have links to all of those where you can buy them on Amazon. I would encourage you, if you're doing any type of research on retirement, he has to be on your bookshelf. With that being said, welcome to Fun with Annuities, Wade Pfau.
Well, thank you. It's a pleasure to be here, and thanks for that very nice introduction.
You've earned it. You've absolutely. I don't know if you've ever been compared to Jimi Hendrix and Miles Davis, but to me, that's who you are.
Well, thanks so much.
Well, let's. I want to kind of break this interview up into kind of 3 parts. And the first part, I've never really seen done with you, but it's something that I selfishly want to know, which is, who is the mythical Wade Pfau? Who are you? Where are you from? What makes you tick? Who is Wade Pfau, the person?
Sure. So, well, born in Michigan, raised mostly in Iowa. I became interested in economics, and that really became my focus in grad school. I moved to Japan, and I worked as an economics professor in Japan, mostly on pension systems in developing market countries. But I wanted to move back to the US, and I started trying to find a way to be marketable, and just sort of stumbled into financial and retirement planning. My background in that regard, I'm more like from the investments world. I was studying for the CFA designation as a part of wanting to move back to the US, and just really steeped in, building a low-cost indexed investment strategy. Mm-hmm. But then as I looked at the retirement planning, the first article I did with that overseas experience, I'd heard about this 4% rule of thumb. Mm-hmm. It's from the investment world. It's kind of the baseline of building a retirement strategy. You build a portfolio of 50 to 75% stocks. You start taking distributions at 4% of the account balance at retirement, and just keep doing that with inflation adjustments, that amount that you take out. And your money should last. And I had data on 20 different countries, and I was curious because that rule of thumb is based on US data. And I found that it did work historically in the US and Canada, but in the other 18 countries, it did not work. And the mileage varied in terms of the international experience. It really, people think it worked 100% of the time in the US, it worked about 2/3 of the time when we look at that in aggregate across the world. So that really led me down a path of thinking maybe investments aren't always the right solution in every circumstance for building a retirement strategy. And I didn't have any background in insurance or annuities, but people started saying, well, hey, if you, yeah, you know, that there can be issues with investments. Why don't you have a look at annuities? And that's what then led me down that path of looking into more depth and starting to then recognize too that we really have completely different viewpoints out there in terms of people can like to ask basic questions about retirement and give completely opposite answers. And either approach can be valid. It really, what works for you as an individual, but certainly I came to see through the kind of doing simulations and so forth that annuities definitely have a strong case that can be made for them in terms of providing a tool to help sustain retirement spending over a potentially very long retirement. And that's kind of then just being agnostic and considering all the different approaches to retirement income, and certainly then seeing the value of annuities and insurance as part of that.
So the fork in the road was the 4%. Did that just trigger something in you to say, wait a minute, why is this such a known and accepted statement? Because my background, I worked for Dean Witter, Morgan Stanley, Payne Weber, and UBS on the stock investment side before I became the mythical Stan the Annuity Man. Is that what really said, you just kind of head slap moment and go, wait a minute, that didn't make sense. Let me look into that. Was that the time? Was that really when you just kind of started digging in?
Mm-hmm. Yeah, because I didn't really have a clear, I didn't know a lot about financial planning. In academics, it's a new field. The first PhD program in financial planning that began at Texas Tech University in the year 2000. It's not, so when I was in grad school around that time, but it wasn't even on my horizon. So that's, starting to look at how this sort of practitioner-based approach to retirement works, and then seeing the 4% rule, going down that path with just looking at it with the international data, that led me down this path of more generally seeing issues, because some people will challenge that international data and say, well, we live in the US, I mean, assuming that's true, and we invest in the US. It doesn't really matter. Like if Bill Bengen, the creator of the 4% rule, had been Italian and he was looking at Italian stocks and Italian bonds, the 4% rule only worked about 25% of the time historically, not 100% of the time. But the argument would be, who cares about that? We live in the US, we have US data. And this can start getting philosophical, but I think because there's so much uncertainty in financial markets, there's value at looking at a broader international experience. But then that just opens so many other doors too. Like now interest rates are lower than they ever were in that historical data that gave us the 4% rule. Mm-hmm. And that's huge. And a mathematical certainty, if interest rates are low, bond yields or bond returns will be low. And you can't spend as much from a bond portfolio. We see the same issue with the stock market and so forth. So I just developed all these concerns that just having everyone go into retirement with 50 to 75% stocks and having the viewpoint that it will be fine because US historical data showed that it worked. I didn't think that was going to be for everyone. And that was really the starting point for all that.
That's fascinating, because when you bring that up, I'm now thinking, well, in a balanced portfolio where you have international exposure in the global marketplace where everything's interconnected and we're on a real-time basis with everyone. Yeah, the 4% rule based upon the research that you have laid out, that doesn't work. And I applaud you for not just, that's your background, is not to take everything at face value, is to dig in and make sure it's true. But I think you've done the public a good service, because you have given validity from a math and research and just an educated standpoint on annuities. Because in the annuity industry, as you know, has earned its bad reputation on some of the sales practices, and all sales environments have good and bad people in it. But I think you've definitely added the foundation that when you're talking about it, there's no sales pitch. It's math, and for you, it's math. A couple other questions before we dig in. Non-retirement plan guru hobbies. What does Wade Pfau do when he says, I don't want to talk about annuities and retirement? What do you do?
I have 3 young children now, so that definitely takes a lot of time. But I mean, watching during the pandemic, watching shows with them, we'd gone through Adventure Time. I thought that was really good cartoon for kids and for adults. And with hobbies beyond that, I've always had an interest in things like amateur radio and shortwave radio. So that's really, the internet has to some extent killed out that entire hobby as an option for people. But yeah, I mean, that's sort of neat. Spending time with kids.
That's neat. Do you consider yourself a lifer in this retirement guru space that you dominate? Is this a passion? Do you wake up and does it keep you going?
Mm-hmm. Because it really does come from real to some extent, what started me in all this was just curiosity about my own saving. I've always been a saver, and so always been interested, and then understanding how to invest that. And I'm not yet at the retirement phase myself, but that naturally extends. And if you're thinking about saving and planning for the future, how do you then build a retirement strategy around that? So that really did motivate me with the early research. And as I've dug more and more into it, yeah, all the different aspects of retirement income planning, like even now things like how you Medicare decisions and everything else, I find it all very interesting because it all interconnects and fits together when you're thinking about how do I build a complete retirement plan.
And your last book really dives into long-term care, Medicare, Medicaid, and those type of planning, which a lot of people don't go into, and you're working that into the whole retirement plan thought and process. One last personal question before we dig into the meat of the matter. How is COVID, at the time of this taping, we're still dealing with COVID and the Delta variant. How has that affected your work, your outlook, or has it might not have, has it or has it not affected you, not from a personal basis, but just kind of how you're viewing retirement, and how you're speaking with people as you go out and you're speaking in front of either agents and advisors or consumers? Has it affected you at all from that standpoint?
It has on a few different levels. And one is just along with COVID, interest rates, they were already low and they've dropped even lower. And it's like just shocking that you can't get inflation protection anymore without taking on market risk. And so that's been a huge issue of just how do retirees transition their wealth into income, because interest rates are just simply so low. Yeah, I'm at a professional level. I live 10 minutes from Dallas Fort Worth Airport now because I did so much business travel. And now that's not helpful for me anymore because I have not been on a business trip at this point since the end of February 2020. But, so there's that aspect, but doing a lot more on the internet. And yeah, I mean, just yesterday I was doing a workshop about budgeting for retirement, and someone was asking me about, well, I haven't been doing this. Is it okay to just use the recent expenses? And was just trying to emphasize, I think a lot of people did spend less in 2020. It was not a normal year for them. So they have to be careful if they are thinking about, well, how much should I spend in 2020? That might not truly reflect their retirement budget, excuse me, because they might want to do a lot more travel or a lot more like restaurants and things. And so the amount they spent in 2020 might give them a misguided view about what a good retirement can be. And I do worry about like people who are at retirement right now and maybe at their peak years for doing all those things they wanted to do, the international travel and so forth. And yeah, I mean, that's a concern that people aren't getting that opportunity to take full advantage of their retirements if they're right. That's where they are right in their life cycle when all this is happening.
Got it. I mean, interesting take on that. As I said before, and we were talking previously before the recording, the people that are listening to this primarily are consumers. Yes, there are some agents and advisors that listen because I'm Stan the Annuity Man. They want to see what I'm doing. But 99% of consumers, and they are either retired, getting ready to retire, thinking about retirement, trying to spell retirement, planning for retirement. And as you know, there's a demographic tidal wave happening right now of 10,000 baby boomers reaching age 65 every single day. So it's the annuity industry is in front of that demographic tidal wave, and they have products that can transfer risk and guarantee income and address long-term care and principal protection, those type of things. From a broad definition standpoint of, say, retirement success, and I know we're kind of getting to the end of the book and missing the start, but we'll get there. What's your definition of a person's retirement success?
To be able, I think, partly like what does retirement mean? And it doesn't have to mean just not working. It's really like having the financial independence to do what you want and to be who you want to be. And, if that involves working, that's fine. You can still be retired, but you're not driven by the need for income necessarily from work. You have other assets that can do that for you. So it's really about finding your passion and your purpose and feeling comfortable that you have a plan that will last for you. A lot of people are worried about market volatility. They're worried, what if I live to 95 or 100? So having a plan in place that gives you the comfort that you will be protected in that type of circumstance, and having then the comfort to really take advantage of your retirement, fulfill your purpose and your passion, and do what really motivates you and makes you happy and gets you up in the morning. I think that's a big part of it.
One of the things I applaud you on that you've done well is to, amongst tons of things, but the one that jumps out to me is understanding a person's retirement income style and why that's important. In fact, it's RISA is kind of the acronym you use, which is Retirement Income Style Awareness. And it really is, that's helping, in essence, that the English version of that is helping people to position annuities, if they fit and are suitable and appropriate, in retirement planning. Can you give us that 30,000 foot view and help the listeners and viewers understand why having a personal retirement income style is important and what those are?
Mm-hmm. Yeah, absolutely. And we call it RISA, the Retirement Income Style Awareness. It means smile in Spanish. And it's really been something kind of percolating for a long time. I think in general, we've known for a long time there are different, well, we've already been talking about it. Like for some people, a retirement strategy is this kind of let's invest a total return investing strategy, 50 to 75% stocks, take distributions. That's one kind of strategy. Another one is it's called either time segmentation or bucketing, which is where we think about let's build bonds and use bonds to cover our short-term expenses. And then that gives us a window where we can invest the rest in the stock market. And if the market goes down, we have this time to wait for the recovery and to hopefully have our stocks recover before we have to sell them. And so that's another kind of retirement strategy. Then we have the different kinds of essential versus discretionary, or it goes by different names like flooring, but it's thinking about for my core retirement expenses, I may not be comfortable taking a lot of market risks. So that's where an annuity can play a role. And you have Social Security. And then if you still like to have some additional protected income, different types of annuities can fill that role. And that's, well, as you know, of course, like simple kinds of income annuities, and then possibly the different types of deferred annuities with the living benefits that give you the protected income, also with some upside potential and some, well, having liquidity for, so you can still get access to those funds. You're not signing away that money forever necessarily. And so the styles are that. It's, do I want to take that total return investing strategy? Do I want a bucketing strategy? Or do I want a strategy where I build a floor of reliable income through an annuity? And in the past, we've never really had a way to help guide people towards one of those strategies or to understand what's best for them. It's so many different like speakers, whether it's the consumer media, financial advisors who may have websites or radio shows, personal finance bloggers. They have a particular style in mind that they tend to think works best for everyone. And that can lead to a lot of mismatching or failed plans or people doing something and then later doing something different. And so with Alex Murguia as a part of a retirement researcher, we did this study of could we figure out how to ask people questions in a way that will help guide them towards a style that resonates with them, that works with them. Because at the end of the day, an annuity is not right for everyone, but it's going to be right for some people. And also a total return investment strategy is not going to be right for everyone, but it's going to be right for some people. And we need to figure out what works for who. And in the process of doing that study, we were able to identify really there's 6 factors that help to explain a style. Now, 2 of them are the most important. The other 4 are helping to tell the story, but the most important ideas are, we call it probability-based or safety first. Am I comfortable relying on the stock market to fund my retirement, or would I prefer some sort of contractual protection to help support my retirement? And then the other big factor is optionality versus commitment. Do I want to keep my options open as much as possible to make any sort of change that I want to? Or am I more comfortable committing to a strategy that I know will work, that I can kind of check it off my list, don't have to be as worried about it at that point, and just enjoy my retirement? I can give up some of the potential flexibility because I know I have a strategy that will work. And then when you look at those combinations, it's what really shocked us when we were doing that was how well they fit into our existing retirement strategies and how well even the stories behind those strategies make sense. So people who are probability-based, relying on market growth, also there's a correlation with, they also tend to be more optionality focused. They want to keep their options open. And that's a total return investing strategy. Rely on market growth, keep your options open. And then the other big one, though, would be the opposite of that. Someone who's more safety first, wanting contractual protections, and is more comfortable committing to a strategy. And we call that the income protection style. And that's the world of really looking at like simple income annuities, building a lifetime income floor, having that reliable income, and then using the investments on top of that for discretion, for more like discretionary types of expenses, but having that secured lifetime protected income floor to cover your basics. And those are the two core strategies. And this is where it's like really interesting. So something like time segmentation, it's more of a behavioral strategy in that it's not really rational, but it was designed to help provide for certain concerns that don't necessarily correlate with each other. And those were somebody who wants contractual protections, but also wants a lot of optionality. You don't, if you're going to sign a contract, you don't really think you're going to get a lot of optionality. But that's what that bucketing strategy does. I use individual bonds to get contractual protections for the short term. It's not giving me any lifetime income, but then I have that growth portfolio to cover me over the long term. And I keep all that optionality for that growth portfolio. And then the other one, it's, as you know, since the 1990s, we've developed this entire universe of deferred annuities with the living benefits. And we call that risk wrap. It's people who are more comfortable with market growth, but also want to have some more commitment to a strategy and to really flesh that out too with some of the secondary factors. They also, they're more worried about outliving their wealth. So they want to more backload or protect their future spending. They're thinking in terms of the technical liquidity that the asset an important aspect of retirement is you have to match assets to their expenses. And even though like a brokerage account is liquid, it may not be truly liquid if you've earmarked it to cover your future spending. And that kind of mindset is the same with an annuity where technically it's liquid, but you're earmarking that asset to cover the future spending. And that, but all these characteristics, that's describing a deferred annuity with a living benefit. And so now we can really understand based on how someone ranks with these two primary factors, now we have a starting point for a discussion. Are you going to resonate better with a total return investing strategy? Are you going to resonate better with an income protection strategy that builds that lifetime protected income floor with an annuity? Are you someone who might think more in terms of the deferred annuity? So you can combine the protection with the upside potential in the same annuity product. Are you someone who likes that bucketing approach, that resonates with you, that you feel comfortable with the idea that if I can just hold on to my stocks for long enough, they should go up before I actually have to tap into them? And that becomes a starting point for the conversation, that now we know which strategy resonates with you and how can we then best serve that strategy and get you a strategy that will work for what you want.
Makes total sense. And you and Moshe Milevsky have been you've been a motivator for how I've built my business Insight, which is trying to match people with the correct contractual guarantee. I've kind of narrowed it down to two questions. I ask people, what do you want the money to contractually do? And when do you want those contractual guarantees to start? Then from there, I can either determine whether they either need an annuity, and if so, what type will provide the highest contractual guarantee, which comes back to what you're talking about, which is how can people find the right plan for their specific situation? It comes down to, and I think you're correct, figuring out who you are as the consumer, because the annuities are not one size fits all, even though people think they are, correct?
Right. And there's so much like variation with annuities. And I know from reading your work that you're very focused on look at just what is the minimum downside guarantee. The upside potential may or may not happen. Don't count on it.
Right.
And certainly, that's a very valid view. But I think then, of course, those annuities with that upside potential are still popular. And it's
Sure.
more how I view that with the retirement income style awareness. The more you lean towards the safety first side, and this is all you're on the commitment side already, but then the more you lean towards safety first, the more you emphasize the downside protections, the single premium immediate annuities, the deferred income annuities, the fixed index annuities, that sort of thing.
Sure.
And then as you shift, you're still in the commitment part, but as you shift to the probability-based side, that's where you may be open to like the variable annuity that might have less downside guaranteed protection, but as a trade-off gives you more upside potential that of course may or may not happen.
Agreed.
But you're more comfortable kind of then rolling the dice, thinking you will get some of that upside potential. And that because you're more comfortable relying on market growth. I mean, we on average, we certainly think the stock market will outperform the bond market. It's just we never know for anyone's retirement if that's actually going to happen for them the way they're hoping. And so that's how we have to decide what are we going to do in that regard.
I always ask people, do you need lifetime income insurance? Some people need life insurance. Some people don't. Some people need lifetime income insurance. Some people don't. But that's the monopoly that the annuity category has, which is that transfer of risk, pension-like payment. I really wish the annuity industry would lean a little bit more heavily from the standpoint of promotion to tell people, you know, you already own an annuity type, which is Social Security, because it's a lifetime income stream. So you just can't cavalierly say you hate all annuities, which makes me laugh. Let's talk a little bit about the long-term care, Medicare, Medicaid portion of that, because most advisors either don't talk about that, shy away from that. I was so happy to see that you addressed that in detail in your latest book. Can you dig into that for us?
Sure, sure. When it comes to long-term care, there's really four ways you can think about funding long-term care. You can build up additional reserves to try to self-fund that. I just say, okay, I'm going to earmark or say, I want this much additional money as part of my retirement assets before I'm comfortable retiring, just in case I experience some long-term care event in the future. So that would be self-funding. A lot of Americans don't really have enough financial assets to self-fund their long-term care should they experience a need to spend like several years living in a nursing home or other institutional setting. So that's where Medicaid can step in. And that's not Medicare, because Medicare does not cover long-term care.
Sure.
But Medicaid is once I've spent down all my, well, there's a whole lot of rules around it, but
sure.
Effectively, once I spent down my assets and income, then Medicaid will help to pick up bills for long-term care expenses. And if I am somewhere in the middle where, or even if I could potentially self-fund, but I can see the value of, you know, with thinking ahead about the inheritance I'm going to leave, not wanting to be worried about whether I get care because I'm worried I'm spending the child's inheritance or something, long-term care insurance can step into the picture. And there's the traditional long-term care insurance, which has made a lot of people uncomfortable because there's a lot of aspects of it that are challenging in terms of rising premiums and lapsing with the policies where you're no longer holding it when you actually need it and so forth. But then now we're seeing more and more growth with they're called hybrid, or it doesn't have a clear name, but different types of hybrid products.
Right.
Either with an annuity, and I don't know a lot about the different hybrid annuity products, but more so on the life insurance side.
Sure.
That you can have permanent life insurance that either allows you to spend down the death benefit of the insurance for a long-term care need, or may even go above and beyond that and provide some sort of, well, first you would spend down the death benefit portion, but then you might have an additional continuation of benefit rider to support additional long-term care. And those are the four basic options: self-fund, Medicaid, traditional insurance, and hybrid life insurance, long-term care, or annuity long-term care.
And the hybrid that Wade's talking about, we call that asset-based long-term care. A lot of people are under the assumption that, you know, they pay, and if they don't use it, money goes poof. With the asset-based coverage for long-term care, which I applaud the industry for pivoting and listening to the consumer, you're not gonna lose that asset. You're gonna have the coverage, and somebody in your family is going to get it, which I think is fantastic. Your second book kind of blew me away when it came out, because I thought it was brave, and I thought it was so outside the box, because at the time you wrote it, reverse mortgages was the wild, wild west. And it might still be. We don't see as many ads for it. We see the Joe Namath of the world, you know, or some celebrity that's no longer a big celebrity is pushing that the 65-year-olds understand and recognize pushing reverse mortgages, or at least looking at it, like a Tom Selleck.
Yeah, he's the one. I think Joe Namath is Medicare Advantage.
Okay, I'm getting them all mixed. I'm getting all mixed up. Okay, 20 years from now, it'll be Wade and I sitting on the couch going, "You ever thought about an annuity?" But the reverse mortgage thing is interesting. I want you to kind of dig into that, because a lot of the people listening to this, they're sitting on a big asset, which is their home. And I thought you were just brave as heck to just say, okay, let's talk about this from a mass standpoint, from an asset standpoint, from a retirement planning standpoint. Wade, let's get your take on reverse mortgages.
Sure. And it's really the same story as annuities in terms of the consumer perception isn't always incredibly positive. So I do get a lot of tomatoes thrown at me, but it's the same story though. It's about retirement planning. Risk changes in retirement. People now have to support their lifestyle over an unknown period. They don't know whether they'll live 5 more years or 45 more years. I mean, I guess it depends on their retirement age, but they don't know how long they're going to live. And then the market volatility and the way they thought about investing changes when they start to spend from their assets. There's this idea called sequence of returns risk, that if you're spending from your investments and the market goes down, you have to sell a bigger percentage of what's left to meet your spending need. And that digs a hole for the portfolio that can be very difficult to dig yourself back out of. And so the way people think about investing when they're saving for retirement, that volatility we experience with investing really gets amplified in retirement. And so that's where it just opened the door about, okay, let's look at this in terms of annuities first, and then reverse mortgages later. It was a very interesting tool for me to look at because it has so many.
How did you land there? How did that? I mean, was it just natural, and you saw Tom Selleck or whoever that was on? I mean, did you go, wait, why is Tom Selleck talking to me? Why is Magnum PI talking to me? How did this happen?
It was something I had always been meaning to look at, and then but there's a research team at Texas Tech University, John Salter, Hale Levinsky, Sean Pfeiffer. John Salter
and Dina Katz. Don't forget Dina.
Yeah, she's part of it. Absolutely. He sent me a stack of articles about reverse mortgages and invited me to a meeting where they were going to be talking about it. And as I was on the flight to that meeting, just reading through that stack of articles, it's the first time I'd really paid much attention at all to reverse mortgages, but I thought it was just really fascinating. And then I started writing programs to test the results of the past research studies in that area, found that all that played out. I mean, there was truth to the idea. It can help manage sequence of returns risk. And it's, you see as a parallel conversation sometimes in the time segmentation world as well, where when the markets are down, if I can spend from my reverse mortgage line of credit, that will kind of give me a bridge or a buffer to allow more time for my portfolio to recover. And I found that really does help manage sequence of returns risk. So reverse mortgages can be expensive to set up, it's true. But in the long run, what I find is you can increase the chances that your financial plan will work. And it doesn't really eat into your legacy in the long term. Kind of these two metrics are, will I meet my spending goals in retirement? And then how much money will I have at the end? So the reverse mortgage, you're borrowing from your home equity, but you're better protecting your other assets so that at the end, your other assets plus your home equity minus your loan, plus your home value minus the loan that is due on the reverse mortgage can be higher than if you just simply didn't do anything or waited. The last resort option is if you just simply wait until everything else has failed and then open reverse mortgage. That doesn't work as well as setting it up earlier. You become eligible at age 62. And so setting it up earlier, once you're in a home that you think you'll stay in and continue to live in, the secret sauce is this idea of a growing line of credit that it's an extra special advantage of reverse mortgages that really help to explain why setting it up early and letting that line of credit start to grow. And it's a non-recourse loan. This is where doing the research about it is interesting. Even if the loan balance grows to be higher than the value of the home, you're not forced to pay back more than 95% of the appraised value of the home at the time the loan becomes due. And you're paying the reason why we talk about reverse mortgages being expensive, it's primarily the mortgage insurance premiums that you're paying as a part of that. But that provides, one of the benefits it provides you is the protection of this, that it's a non-recourse loan. You don't have to pay back more than the home is worth. And so when you build that into the simulations about retirement too, it's a really powerful strategy, just like an annuity. It's a way to help manage these retirement risks that people aren't always thinking about because they're used to the accumulation pre-retirement investing and not to what happens post-retirement. And it speaks to why a reverse mortgage can help or why an annuity can help and why you really have to think more holistically about all the household assets and not just get too focused on some sort of investing strategy alone.
Fascinating. And I think it's interesting that both annuities and reverse mortgages, I mean, the misconceptions, misperceptions out there are just horrific in a lot of cases. So you're saying at age 62, you should at least be thinking about or visiting or looking under that rock to see if that makes sense and at least establishing that. Am I right?
Yeah, it's definitely worth having a look at it. And if you are planning to move in the next couple of years, it's probably worth waiting until you're in a home that you anticipate staying in, because of there's a large upfront cost to set it up. So it works better if you're planning to stay in the home a long time. And then also for couples, if you're close to the same age, you have to be at least 62 to be a borrower on the loan.
Mm-hmm.
So there could be value to waiting until both individuals reach age 62 first. But then, yes, absolutely. Even as a part of a responsible retirement income plan. So even if you have a sufficient amount of assets that you're unlikely to run out of money, the reverse mortgage can still help to improve your outcomes so that you can meet your spending goals, but also then in the end, leave a larger legacy behind as well by being more strategic in how you approach the retirement planning process.
It's an unknown retirement insurance lever that you can access that most people don't feel like accessing. And I think, or don't even know. If you were going to explain setting up a reverse mortgage to a 9-year-old, no offense to 9-year-olds, of course, how would you explain that? Because I know a lot of people on here on this have heard of it, not thought of it, and now Wade Pfau, and they found out you wrote a book on it, is saying, hey, you might want to look into this. Explain 30,000 foot view, just what you're doing with the home.
So when you set it up, and if you set it up around age 62, based on where like interest rates are right now, and you get access to about 40 to 50% of the home value that then becomes a line of credit that will grow over time throughout your retirement. And you can just spend from it as you wish. And it's proceeds from a loan, so it's not taxable income. It also, that can help with some tax management strategies too, where if you're going to go into a higher tax bracket, you might tap into the reverse mortgage as a spending source that won't push you into the higher tax bracket and so forth. But it's a way to just create liquidity for your home equity so that you can also spend, just like you spend from your investment portfolio, you can also spend from your reverse mortgage and balance those or coordinate them in a way that, like when the stock market's doing well, go ahead and spend from your investment portfolio. But if the stock market has a downturn, maybe tap into the reverse mortgage that year. And by being able to better manage that, it's just helping you better manage the overall retirement situation and better manage the sequence of returns risk. This idea that a market downturn can impact you more in retirement if you're forced to continue spending from the declining investment portfolio in those circumstances.
And when you say grow, for the listeners and viewers, they're yelling, I'm sure they're yelling at the speaker going, grow, what does that mean, Wade? Tell me what grow means.
Right. So probably everyone can understand that if I borrow money, the loan balance will grow. The cool planning aspect of the reverse mortgage, and I think it was an unintended consequence, the assumption was if you open a reverse mortgage, you're probably borrowing from it. And so then this growth would just be the growth of your loan balance. The cool planning aspect of the reverse mortgage is you can open it up, but you have to keep like a $50 balance at least, or maybe $100 with some company. You have to have some minimal balance. But otherwise, you don't have to borrow from it. And so you have this principal limit, which is what you borrowed plus what's left over in the line of credit. And that's the thing that's really growing at some rate over time. So if you open it and you don't borrow from it, your line of credit is growing like the loan balance would have been growing. And that's what grows. And so then later you have more line of credit that you can tap into. And at some point there was so something happened with Social Security that then happened with reverse mortgages. In the early 2010s, people figured out all these cool planning strategies where you could get extra spousal benefits out of Social Security. And then the government shut that down and started phasing it out in 2015. Well, this line of credit growth was amazing. I'd written an article, probably in 2015, about how there's like a 50% chance that the line of credit could be worth more than the value of the home in about 20 years. And then in 2017, wow, the government caught up and changed some of the parameters around that. So everything I'm talking about is still true. It's just not as shockingly amazing as it was pre-2017. There's a second edition of my reverse mortgage book because I had to entirely rewrite it after that 2017 rule change. But everything I'm talking about right now is thinking more in terms of the current rules, which is still, it's not as likely that line of credit will grow to be worth more than the home, but it does grow, and it does speak to the value of opening it sooner and letting that line of credit grow rather than waiting till later and opening it and missing the line of credit growth during that period.
What a great strategy. I think that a lot of the baby boomers out there grew up in a world where they were told, it's good to have no debt. And a lot of the clients that certainly work with me, a lot of people I talk to, they have no debt and they're proud of that. And I think maybe one hesitation for everyone would be, why would we do that? We don't want more debt, but you're not incurring the debt. You're setting it up as part of the plan as just in case, by the way, I might need this. And why wouldn't you? Because, the house is, I don't know what the stat is, I'm sure you do, which is the primary asset for most people, if they just look at it at what it's worth. Am I correct about that?
Yeah, at the average, for the average American reaching their 60s, the home equity plus it's like twice as much as the investment portfolio. Or when you look at their investments in their home, the home is worth about 2/3 of that total. So it's a bigger asset than the investments for most people approaching retirement age. And yeah, the default advice is ignore the home. It's not really part of the retirement plan. And that's where the push with the reverse mortgage concept is, no, this actually provides a way to incorporate the home into the retirement plan. And definitely there is a psychological hurdle to the reverse mortgage, as you're saying. Like people, it's a mortgage. So if you borrow from it, it is a loan. It works a little bit differently than most loans people are used to because there's no fixed payment obligation. You can wait until the end. Like the reverse mortgage terminates when you've either passed away, moved out of the home for at least a year, and or don't do your basic homeowner obligations, like very basic home maintenance, paying homeowners insurance and property taxes. But as long as you're meeting the requirements, you don't have to make any sort of payment until one of those things happens. And so while it is a loan, because it doesn't have that fixed repayment schedule, it works different than how people are mostly thinking about the way loans work.
Definitely, when I turn age 62, I'm going in that direction just because it makes total sense. Have advisors, masters of the universe, however they want, wealth architects, and the people that you talk to about this, has there been good reception to that? Or is there an initial reflex from people about reverse mortgages based upon just the bad information that a lot of people have gotten about reverse mortgages? What has been the reception?
Well, more people are becoming open to it, but yeah, I think there's still it's almost like a universal misconception that you somehow hand over the home to the bank when you initiate the reverse mortgage. And we're talking about more than 90% of reverse mortgages are the home equity conversion mortgage program. It's administered through the government. There's a whole set of rules, and no one handed over the title to their home. So I think everyone just starts from that misconception. And that makes it a struggle from the very beginning because it does require taking some time to understand how it actually works. So it's a slow process. And then I have seen a lot of financial advisors become more open to it. But then the problem they have is their clients may not be open to it. And so,
Got it.
And the client might think, hey, what's going on? Why are you talking about a reverse mortgage? Are you trying to scam me? So it's a very sensitive conversation.
Well, you're doing a good job of giving it validity, which is what you've always done. But it's eerily similar to when people call me up and say, I'll never buy an annuity because when I die, the evil annuity company keeps the money. And a lot of people think that that's true. And me and you both know that's just one of 40 different ways that maybe structure an immediate annuity or deferred income annuity, but it doesn't apply in most cases. But that's what people believe. And if that's what people believe and that's what they heard, and then they hear, I hate annuities or I hate reverse mortgages, they're not open to it. I'm hoping that people will hear you, because the next topic I kind of want you to speak about, and I know it's basic for you, but once again, our listeners and viewers need to understand risk pooling and what that means from the standpoint of life insurance and annuities when we're talking about implementing these strategies, if they are suitable and appropriate for them. So can you kind of give us a basic view of risk pooling?
Sure. Yeah. And risk pooling, so we had traditional company pensions, especially in the post-war era in the United States. You work for 30 years and then 60% of however it worked, but 60% of your salary gets replaced and it lasts for the rest of your lifetime. That traditional company pension pools both market risk and longevity risk. And what that just means is I'm not taking any risk about what the financial markets are going to do or how long I'm going to live. My employer is taking that risk. Over time, they're going to be investing to pay these payments to me, but they can, because different workers are starting their careers and ending their careers at different times, the employer can focus more on providing a pension that matches the average market return over time. And then also they know as well, some people will not live very long in retirement. Other people will live longer.
Mhm.
So if I'm trying to manage that risk on my own, I have to be worried, well, what if I retire when markets go down? And what if I retire and then it's good that I live a long time, but it's just, then it's a lot more expensive for me to fund my retirement. Well, the employer could pool that risk because they can pay everyone the pension based on an average lifetime. It's like your pension's based on, you'll get an average market return and live an average length of time. And it doesn't really matter what happens in your individual circumstance. You're protected. Even if you're like, if you had been investing that money on your own, you would have got really poor returns and you end up living a really long time and can't afford to pay for the retirement. The employer took on all that risk. But that traditional company pension, for most people, I mean, they still exist, but they're much rarer these days. And an annuity is a way to build that pension on your own through an insurance company, where the insurance company will pool that risk. And especially it's the longevity risk. If I'm 65 years old, I might live to 68. I might live to 98. I don't know. I have to worry, if I am worried about this, that plan more, what if I do live to 98? And then I have to spend less to stretch that money out for longer. The insurance company, though, has the actuaries who are figuring out, well, if the average person lives to 86, then I can pay everyone who buys that annuity a higher level payment because I can pay everyone like they're going to live to 86. And then for those who end up not living as long, that money doesn't go to the insurance company. It goes to the other members of that risk pool who do live longer.
There you go.
And so if you live a long time, it's great from the perspective of you got your money's worth out of the annuity. But given that people don't know in advance which group they're going to fall in, it helps to raise the standard of living for everyone in the risk pool, because everyone can now spend like they're going to live to 86 or just however that the life expectancy, rather than being worried, well, what if I am the one who makes it to 95 or beyond? I can enjoy a much higher standard of living because I pool that risk through the insurance rather than accepting and taking on that risk on my own and being forced to spend less as the only method I have to manage that type of risk.
And I am always breaking things down to a very simplistic level, because people always say, well, what's my return on investment or something like that? And I'm like, there's no ROI until you die. Up until that point, it's a transfer of risk. Last part of this segment, I want to transition, and I appreciate you going into the details of that. And once again, for everyone listening and viewing, we're going to have all of Wade's, his website, retirementresearcher.com, access to his books where you can buy them on Amazon. I would encourage you to do that. I want to close with a few questions about just some other things when it comes to retirement. The non-financial aspects that you would deem important in retirement, as you're also looking at these other mathematical views into retirement. What are the non-financial items you would like people to focus on?
Yeah, and I do focus mostly on the finances. So I had to do a lot of background reading on that when I was writing the chapter and the guidebook about the non-financial aspects. But they're as important as the financial aspects, and maybe even more important, because at the end of the day, people can adjust to their finances. And even if it's just a Social Security benefit in the end, people can adapt. But the non-financial aspects are a lot harder to adapt to. And kind of a rule of thumb is, you want to have something that you're retiring to rather than something that you're retiring from. Like, you don't want to retire because you hate your job. You want to retire because you have something else you'd rather be doing that will give you purpose and passion.
Wade, repeat that again.
Yeah, it's not that you want to retire to something, not retire from something.
There you go.
And that we can think about. So work, of course, provides us income, but it does a lot more than that. Other aspects or other like positive life experiences we get through work. It's a source of social engagement, friendship, camaraderie. It's a structure for the day. Like, I know I have these hours of the day. I'm going to work. A routine and structure that can be important to some people. It's a sense of identity for some people, that like when someone asks who you are, if your response is your career, like I am an accountant or I am a lawyer, that can be a big part of your identity. And so retirement can take away that identity. And also people can feel like they're valuable contributors to society through their work. And if they don't have a replacement for that, they might also then have less of a sense of self-worth when they don't have that career as part of who they are. So working provides all these positive attributes, that need to be replaced as part of retirement. And that's a big aspect of the non-financial side of how are you going to spend your days? How are you going to continue to maintain social engagement? And like, it's, if you don't have anything that forces you to get out of the house, it can become a hurdle for you. And you're going to be spending more time potentially with a partner or spouse. And how are you going to manage that to make sure that gray divorce is on the rise? And spouses or partners need to communicate with one another to make sure there's an understanding about what are you going to do together as a couple? What will you do separately? And how will you manage the extra 8 hours of the day that you're spending together that you weren't necessarily used to doing? And especially now that the children have grown, you don't have that child rearing as the source of what you're talking about or what you're doing together as well. So that's kind of a nutshell of the non-financial aspects, the things that are really important to be thinking about. And also, I mean, health, taking care of your health and mental health, and just the risk of people becoming depressed when they leave work because they're just losing all these benefits of work above and beyond the income that can lead to negative feedback loops. And it's just important to really be thinking about and to prepare for what's going to give you purpose and passion and make you have that retirement that you really want to have, and not just fall into the inertia of the days just wasting away. And a lot of people will have a honeymoon period at the start of retirement that could last a month or a year even. But at some point, sitting on the couch all day or going golfing every day, there's got to be something else to really sustain a successful, happy retirement experience.
Definitely. Wayne Gretzky, hockey player, always said, I don't skate after the puck. I skate to where the puck is going to be. For Wade Pfau, where's the puck going, Wade? Where are you trying to get to from the annuity industry, from a life insurance industry, from a product standpoint, and where do you see the future for the industry products, and where's that puck going to be?
I've been really excited at a personal level about one of the topics we discussed was that retirement income style awareness idea. And like my dream is, I think there's so much potential value there that if every one of those 10,000 baby boomers reaching age 65 every day, like if everyone just started by taking the RISA, the retirement income style awareness, understanding their RISA profile, which is just the starting point of what retirement strategy resonates with them, I think that could provide so much value and service as a starting point for people to then think about how to build their retirement strategies. So kind of what's driving me right now is getting that message out there and trying to build that momentum that the RISA really is the starting point. We have risk tolerance questionnaires, and maybe a lot of the listeners have taken one even, which is, for your investment portfolio, what stock allocation should you use? That's not really all that relevant for retirement, or it's still important, but it's only for the investing piece. It doesn't speak to, and this is what we showed in the research, like a traditional risk tolerance questionnaire doesn't have anything to say about are you concerned about meeting your core expenses over a long retirement? Like, are you concerned about outliving your money? It doesn't speak to liquidity concerns, which is, do I have reserves? What if I have a big long-term care bill? Do I have sufficient funds to help cover that? The risk tolerance questionnaire doesn't help with that. It can kind of describe lifestyle concerns, which is the overall kind of the accumulation investing process of just how can we maximize our lifestyles as much as possible. But it's not a good starting point for the retirement conversation. First, people need to understand their style. Then they can take a risk tolerance questionnaire. And I'm just trying to help build the momentum to get this idea out there that understand your style. It simplifies the conversation. It provides a vocabulary. In my website, I get so many questions from people. And now the vocabulary is changing. Instead of somebody asking me, should I do this or that? They say, I'm time segmentation. Should I do this or that?
Nice.
And then it's easier to answer the question. Of course, the question still always, it depends. But now one of the big, it depends, is less, there's less uncertainty. Now we can have that conversation. Is building a bond ladder right for somebody who has time segmentation? It's much more likely to be correct for that type of person than for someone who has a different style.
Great answer. Wade Pfau, a true thought leader in the industry, an icon, as you can tell by just listening to him. He's a good person, and he's trying to help, and he's trying to create a foundation of facts and insight that will help the retirees, pre-retirees, post-retirees, whatever you want to call yourself, baby boomers. And it has been an absolute pleasure for you to be on the Fun with Annuities podcast. Hope you're going to join us in the future. I wish you the best on this new book. Yeah, it's fantastic. I do recommend all 4 of his books. But Wade, any last thoughts before we close this thing out?
No, I've admired your work for a long time, and so it's a pleasure to talk with you about it. Thank you.
Well, great. Hopefully we can meet one of these days. I'll buy you dinner in a post-COVID world, I hope. But I want to thank everybody on all the podcast platforms and the Fun with Annuities YouTube channel. Don't forget, I also have a Stan the Annuity Man YouTube channel that has over 400 videos at the time of this taping that are informative and non-salesy. So with that, I will see you next week on Fun with Annuities.